Hi, this is Randy Finney with Right Side of the Chart, and this is a midday market update for Thursday, May 16th, 2019. It's just about noon here, so I wanted to do a midday update as we head into the lunch hour. Sometimes trading volumes will drop off there, but that's more so in the older days. As more and more trading's done electronically, you don't have the impact for traders going to lunch. But either way, let's watch this. Here we're at. Let's just focus right now on the 60-minute charts. That's really where my focus has lied. We're right about just a hair above, and we've had a lot of upside momentum. So we're practically right on that level. And right now, the uppermost bounce target there, preferred. Like I said, this one is also pretty solid resistance. We could come up here about 187, but I'm looking for this rally to cap here. And we have a previous reaction high, so we're again within a range. You're talking 200-point ETF right here, and we're just a hair above it, 30 cents. So that's, for all intents and purposes, we're stalling out so far at that 185.53. That's my preferred upper bounce target. Let's see what happens here. And on SPY, same story. We have here's one chart. I have a couple charts. So it's about 289. Right about 289 on this board here that I've been sharing. Had it a hair lower, and we're right there right now. You can see 288.83. We're at 288.82. So that's it. And what I'm looking at here, yes, pretty impulsive rally. And again, we popped the downtrend line, the price channel there, and that sparked a rally today. So I look at it this way. I still believe and maintain an objective level. It's where I've added my final lots of shorts for what I think will be the next leg down. And I just want to make clear again that I don't plan to add, nor do I think it's prudent to add going forward from here. Because if we continue to power much higher, even though there's certainly some resistance levels in play, it depends how you've been scaling. I'm generally speaking, I'm talking about my trading plan for the swing accounts. Active trading account, I will, go long and short. I might be long against short swing positions for very short-term bounces, but as of now, that's where I'm back to where I was last week. A couple times where I closed out some short positions, and I've added those back here. So, that's. I know it's contrary to a lot of people. It's I guess contrary to human nature. When you see something going up, a strong rally, it's recency bias. You think it's going to go up forever because we've been going up. I view this again as an objective level to add shorts. I like to short on bounces back to resistance. I don't get bearish after we've fallen 7% or whatever it was on QQQ. We're oversold and we have divergences building. I start to get bullish then, looking for a near-term bounce. So again, you have to compartmentalize or separate the short term, and this is intraday charts, this is shorter term stuff. Day bounces and moves that can last for hours are usually just days. And when you go out here to the daily chart, again, this formulates the bigger picture with those breakdowns and what appears to be an initial thrust down off the highs with a double top failure in SPY. And on QQQ, similar story, except we had a failed breakout. This brings up a point. Somebody asked in the trading room today if they were to add shorts right about where we are right now on QQQ. They asked, the question was maybe 20-30 minutes ago. Where would the stop be? Now, my answer was this. It depends completely on your price target. If you're just looking for a pullback trade or maybe another test of the 178 lows, which is certainly a possibility. Again, we need to see this go. This is the next big sell signal on the market in the next objective level, if that goes with conviction, to add to shorts. But this is certainly objective here too. And, you get a better price shorting bounce backs into resistance, although this rally can continue on, and like I said, you want to be more concerned about where to cut your losses if this just proved to be a correction on the road to new highs. That's still very much yet to be determined. But what I can tell you, and to get back to what I was just saying a minute ago, my answer was this. I think a stop above, a little bit above that 188-ish level, call it 189, ideal in a daily closing basis. I think that would be an objective stop for anybody adding to QQQ shorts here. Why? Because it's 188 roughly is that double top high back from 2018 in the Qs, and we broke out. We traded above it for a while, and as I said at the time, I don't chase breakouts to new highs when they are overbought with divergence because they usually fail. So that's a failed breakout so far. So any push back there, it's the bottom of that trading range right there I boxed in. That was the breakout to new highs. That's where it failed. And so now 188-ish, and you want to give it a little bit. If you trade, if you are swing trading, remember, if they get close to it, I can almost assure you they'll probably pop it on an intraday basis. That's what they do. They meaning whether it's individuals or just nefarious, forces in the market or just the way things work. Usually you'll get a pop, and it's a stop clearing pop because that's a well-watched resistance level. So I think a lot of retail shorts probably have their stops right there, and a lot of retail longs will buy a breakout above 188. And so give it a little room, not much. And it's up to you. Maybe a close above 188 or 189. You also have to look at how it looks intraday as well. You might see some divergences or other things on the intraday charts that convince you of a reversal or convince you that you're just going to keep going on up. So those are things we'll be watching. And as of now, like I said, we're at those levels that the uppermost bounce target for this kickback rally. So let's see what happens here. I'll also say, if you look at these candles, nice, big, green, and impulsive, and it's a big if right now, but if they get wiped out, especially if they get wiped out within the next few sessions, you see something like this, that's a get out of Dodge moment for me, for the markets. I mean, not that I'm in longs, but if I were, fewer things would be more bearish than to just see this get wiped out. So just keep that in mind. Again, that would entail a break of that 178 level. That would just be an utter knife through the heart of the bulls, all the longs that bought this dip, thinking the market's going to go to new highs. To see those two big green candles right there faded, bigger than the red candles we have going down. Right now, probability of it happening, it's hard to say, but I still lean that way. I put it over 50%. We don't have to wipe them out in one fell swoop either. We could work our way down. So to me, I guess the point I was trying to make, if there is a sharp reversal soon, some big red candles and just a couple trading sessions that take you down through there, that would be extremely bearish. But I'll certainly take a stair step lower as well. But if we start moving down, remember, we're going to have the first thing that everybody will be watching is another test of that 178. That was a pretty important support level, as was the level on SPY that we just hit the other day. 281-ish. Again, a back test of the levels there, those reaction highs from the fourth quarter, and then of course we danced along it there. So that's the bigger picture. Let's not forget, we still have a failed double top on SPY. We're still well off the highs, and we also have the failed breakout in QQQ. So the only thing I can say right now is that volatility has expanded. What happened is we were inching our way towards the highs. You can see these small candles. We had price compression, but once the correction started, volatility expanded. And as I've said recently, that doesn't just mean volatility doesn't just mean going down. It means bigger price swings day to day. So we're seeing a couple big intraday moves recently, just as we've seen to the downside recently as well. So this is just par for the course right now with volatility having expanded. Yes, the VIX drops on days that you go up. That doesn't mean that volatility has gone away. It just means the VIX is a ratio of measures put to calls, the amount of puts and calls being sold. So right now everybody's bullish, buying calls. They don't want to buy puts. They want to you have shorts covering, and that causes a drop in the VIX. Which, by the way, if you think that we're going to go down, I can tell you this: TVIX or one of those VIX ETNs or VIX futures or options, if you trade those, probably not a bad way to go today. Again, because it all right now, like I said, we really shouldn't go much higher. So this is where you have an objective shorting entry with a stop not too far above. Let's say that 291, 292-ish level on SPY right there if you're a SPY trader. That's it. I don't want to make much more of it. Let's just watch and see how the day goes. We're only halfway through the trading session now, so let's see this afternoon. Can they build on these gains? Can they break that out and print a solid close above those levels? If so, got to give it to the bulls at least today. It still won't take us to new highs. I very much doubt we're going to see new highs anytime today, probably even this week. So like I said in recent videos, if we cross that line, it doesn't automatically flip me from, okay, going all in long, I'm completely bullish, the bearish case has now been wiped out. No, not the case. It certainly dampens the bearish case, and at that point, again, I want to make clear, I don't think it makes sense to keep, adding to short positions. Typically, experienced professional traders will scale up on a position, meaning if it goes their way, they add it at higher and higher, less favorable prices because it's confirming that they were right. The trend is going in their direction. And I'll typically do that as well, with the exception of if I have a predetermined plan to scale in, as I have recently, because there is a range that I'm unsure of where the bounce might go. Then that's my scale and plan. However, what you don't do, and I can tell you, I've seen this over the years. I've read about it, and I've seen a lot of chats, things in the trading room where people dig down, average down on a position. They keep buying, whether they're long in a stock that keeps falling, they average down thinking, okay, well, I'll buy it here at 282. Oh, it dropped to 270. I'll buy some more here, and I'm averaging my lower cost. If you're doing that, and you're doing that in a trend that continues down, you're just digging yourself in a hole. That only works if you have a high degree of confidence you're going to reverse. And again, I would do it if it's a plan that I had ahead of time to scale into a position. But for the sake of just averaging down on losing position to lower your cost basis, more often than not, that's a bad idea. All right, so I'll just show you one other chart, and we'll keep this one quick. Keep this video short. I know some of you might work full-time jobs, not have a lot of time to watch the videos. There's a downtrend line on SPY. Here's that big megaphone pattern that we've been tracking for a while off the highs. Like a descending megaphone pattern, if you will, and so far SPY has hit that. So we have 1, 2, 3 now. If we get a reaction here, fourth reaction, and there's also that 28.92 former price target support level. Support once broken becomes resistance. We kicked back 1, 2, 3 times to that level now. So it would be really nice. It would mesh well with the the bearish scenario if we reversed right here. So again, we continue to power up and close above these levels, then it really kind of mucks up the near-term bearish case for now, and at least puts me on standby hold. Remember, there's still plenty of work for the market to be done. That's a pretty big level right there, 29.1750 on ES, and you have a comparable level on SPY as well. So let's just watch, and if we pop that level, I'll watch, and anything much above there, even though I'm not positioned in ES, but anything above there and the comparable levels on NQ, that's more where I'm just concerned about scaling out and then sitting back and watching what the broad market does and focusing on trading other things. There's a lot of stuff out there, natural gas, gold, wheat, which is up again today, things like that. You don't have to trade the markets. It's just when there's a lot of volatility, I hyper focus on my analysis on the market and trading, because it's easy to trade the ETFs or the futures, because one instrument, you're trading a whole basket of stocks, and when you have a lot of volatility, 1% plus price swings in the indexes, then you can profitably day trade or swing trade. But when you get back to a slow grind period like we had again back here, or right here, that's where day trading is not very conducive, especially in these choppy sideways markets. That's where if you know what you're doing, you can day trade, but swing trading, you just get chopped to pieces. So all right, we'll wrap it up here, and of course I will do an end of day update, whether it's with a few static charts or another video at the end of the day. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.